Fade to black. Welcome everybody to the Lone Lab Podcast, episode 1. We are your hosts. My name is Jimmy White, and I'm here with my good friend, my good colleague, Mr. Jimmy Weber. James, how are we doing today, brother?
We're doing incredible. We're excited. I thought I'd be a little bit nervous, but I'm not. I'm just ready to conquer this.
We've had a little practice here. We put some promo videos out, and people were like, how the hell can we listen to this podcast?
People were digging the hype.
They were digging it.
They were digging the hype.
This is the first official episode of the Lone Lab Podcast. We are super grateful and blessed to be here with everybody. Real quick, we just wanted to give another recap of kind of why we're doing this, right? This is for the people. We were just talking about this before. This is for the people out there, for you guys, for anybody who's tied into real estate, whether it's a buyer, seller, agent, attorney, insurance agent, anybody who wants to just know the ins and outs of real estate, but get it from a consumer standpoint, right?
Right. We're two guys that have been in the mortgage industry for over a decade each, a little bit longer. So I think a lot of this is going to be based on education. But with that education comes so much more because we have the real life experience of being able to outline that and relay it in a way that is a little bit more consumer friendly.
And you said with the real life experience, we've kind of talked about this before between us, is we've been through buying a house with a family and going through the mortgage process. And I tell clients a lot, this is intimidating, and it was intimidating for me. And I'd been doing it when I bought my house, I think for 6 years already. And when you put yourself in client shoes and go through it, it's crazy.
It's interesting to think that I didn't own a home when I started doing this, but I also was 22 years old, right? I didn't have that opportunity to go through what I was telling people and advising them to do, which seems so ass backwards.
It definitely
when you think about it.
It definitely is. So yeah, we're here to just give some real insight from two normal guys about what's going on in the mortgage real estate industry. And again, we're super grateful to be here. We want to give just a little bit of a background on each other, just where we came from, family life, et cetera. So again, Jimmy, I've been in the mortgage industry we're going on our 10th year now, both of us. I'm from Rockford, Illinois. I got to give a shout out to the 815 Rockford. Born and raised there. Lived in the city for about 6 years and rented, and then met my beautiful wife, Sydney, in the city. We now have two beautiful daughters, Ronnie and Ruby, and we're living in the south suburbs. We own a single family home out there. We've been doing this thing in the suburbs about 5 years now, and doing the mortgage thing for about 10 years. So that's a little bit about me.
Jimmy Weber over here from Evergreen Park, Illinois. Southside Chicago.
Southside.
Got in the mortgage business, kind of fell into it right out of school. I was a financial planning major, so I knew I'd be doing something with money, but I didn't really think I'd be doing mortgage. Shout out to our boy, Matt McGinnis. Really good friend of mine, Steve McGinnis. One of my best buddies' older brother, Matt, was a branch manager at the unfortunately now deceased Midwest Equity Mortgage. So we came in as call center loan officers for this new group, eClick Lending, which of course really changed our lives. Fast forward a couple years, we're getting into more of the retail loan officer game. I meet my now beautiful wife, Lauren. We have an 18-month-old daughter, Julia, who keeps us on our toes quite a bit. We have lived together in the city for 7 or 8 years. We're in the Bucktown neighborhood of Chicago. Absolutely love it. And what a ride.
What a ride.
What a ride.
And it's funny you mentioned Matt McGinnis, and shout out Matt and Steve, his brother. So that kind of brings us to how we came about. I went to college with Steve and played football with Steve McGinnis, who was one of your best friends growing up. Mm-hmm. And Steve was like, hey, do you want like a sales job at a mortgage company? And I'm like, I guess. Like, I don't know.
We were a couple months ahead of you, right? Like we started, I think, January 2015. Then you were still in school.
Yep.
So you came in right after.
Yep. So I came in right after. And that's kind of where our connection started, was through Steve McGinnis. And, we have been together, not at the same company, but together at different companies for the past 10 years.
Right.
Learned a lot from each other. I know you kind of trained me up as I got into the industry, and
to think about what I knew then versus what I knew now, training you. That's hilarious.
For sure. So again, we've been together for 10 years, and this Lone Lab podcast has been a long time in the making. We've been talking about this since July of last year, I think, and we finally got it off the ground and running. Yep. We call it the Lone Lab Podcast because right now we are in the lab in Oak Brook, Illinois. So this room, Jimmy and I helped put together and kind of design with the help from a lot of people from Leader One, the company. They put in a lot of the legwork. We just kind of ordered all the stuff, but put together a bit of a plan. And then our buddy Dan Solaski and his wife really pimped this room out. So we are in the lab. We have the money tree back here. The money tree has also been with us for,
That's a shout out, Dave Hansen.
Dave Hansen.
Yeah.
This has been around, been following us around in our mortgage career for a long time. This is where we make it happen with the money tree. So
Where it all started.
welcome to the lab, everybody. And like we said, we're really glad to be here with you. So we're going to have some different segments on each episode, but one consistent segment that we're going to do is the mortgage rates in a minute segment. We understand how important interest rates are in the mortgage industry to everybody involved. That's all we talk about.
We do. It's a lot. Unfortunately, is a lot of the ebb and flow in the mortgage industry because so many people are so concerned with interest rates and what they're doing each and every day. And it does impact financial decisions, obviously.
So that being said, Mr. Weber here, James, is going to run the market or the mortgage rates in a minute segment on each and every episode. He's a whiz when it comes to mortgage interest rates. He's going to give us a little bit of a breakdown, and then we'll have maybe a bit of a conversation about it after.
Yeah, I think it's worth mentioning on this first segment, why interest rates were so low for quite some time due to COVID, right? Obviously, COVID was a black swan catastrophic event. The government used real estate to get us out. So the government printed an insane amount of money and used an insane amount of that money then to turn around and buy mortgage-backed securities, which then took interest rates way down. When interest rates were way down, property values skyrocketed as everybody was going out of their way to purchase that next home. A lot of people buying homes sight unseen, which is crazy to think about.
So sight unseen means
you don't even put your boots on the ground. You just know that, hey, I have a 3% interest rate. I don't really care what it looks like. I see pictures on Zillow and Redfin, and my agent did a video, and they buy the house. Now those people, unfortunately, are a little bit stuck. They don't really love the home anymore because now the interest rates are in the high 6s, low 7s.
It was a crazy time for us. A lot of transactions being done, a lot of homes going way above asking price, way above
We're
list
talking
price,
some homes with 50 offers in competitive markets, and that's not an exaggeration.
which is wild.
Absolutely nuts.
So there was a give and take is kind of what you're saying is, hey, super low interest rates, but then also it's almost impossible to get an offer accepted.
Yeah, exactly. And it kind of brings us full circle, right? Because now we're almost trying to dig out of it. Inflation is still so incredibly high, and it's not going on anywhere, unfortunately. The inflationary numbers have, of course, dropped, which is good, but this doesn't happen overnight. During COVID, rates were so low. After the Fed talked about a soft landing for so long and trying to cut rates. Now we're at the point where rates have been cut 75 basis points or 3/4 of a point on the federal funds rate, and mortgage rates have actually gone up a percentage point since then.
So, and I think we need to address too, because I mean, I've made so much content about, we're talking about the Fed rates, right?
Mm-hmm.
Do the Fed rates affect mortgage interest rates?
Long term, yes, it's something that's followed, but overnight, absolutely not. And the reason is simple. The federal funds rate is quite literally the rate that banks charge each other to lend money overnight.
Overnight, right?
Whereas a mortgage is a 360-month loan. It's a 30-year loan.
Much longer term than trading money or selling money or lending money overnight.
And that's why the federal funds rate and mortgage rates aren't the same rate, because no bank is going to give you that overnight rate for 30 years.
For sure.
Just like no credit card is going to give you a mortgage rate for 30 years, hence why credit card rates are so incredibly high.
And I think it's super confusing to people out there when you see the headline, the Fed's cut rates 1/4 percentage point. I mean, how many calls do we get from clients being like, hey, is my mortgage rate 1/4 less because they cut the rates?
Well,
and I get it.
Thanks for saying mortgage rate there, because the question then becomes, what's a rate? What's an interest rate? There's so many different types of interest rates, of course. Your mortgage rate and your federal funds rate, though, are very different, extremely different.
For sure. For sure. One thing I was thinking of as we were thinking about these segments is if people out there want to kind of follow where mortgage rates are going on a daily basis, which I don't suggest. I mean, that's almost like crazy a little bit.
You can't time the market in anything, right?
You can't.
You can't. It's impossible. We wouldn't be sitting in this room if we could time the market.
But if you want to kind of look and see something that directly, and I wouldn't even say directly, but something that correlates with mortgage interest rates, one thing that we always tell our clients is go and look at the 10-year treasury.
Right.
And the 10-year treasury, all you need to do is type in 10-year treasury on Google. And I think CSNBC comes up. There's a bunch of different trackers that come up on Google when you type in 10-year treasury. When the 10-year treasury is down, when it's in the red, that means mortgage interest rates are more than likely going to be down for that day. Now, is it going to be directly correlated? No. But in the grand scheme of movement with mortgage rates, the 10-year treasury is down on that day. Mortgage rates are probably moving down or lower. If it's up, mortgage rates are probably moving higher.
Right. And many people don't realize that mortgage rates actually trade like any other stock or bond. It's based on mortgage-backed securities. But mortgage-backed securities follow the 10-year treasury. It's like a dog and a person on a walk. The person is the mortgage-backed security, but the 10-year is the dog. They're following that,
for sure.
Even though they're the person's taking them on the walk, but where the dog goes, the person goes.
It's a really great analogy. I'm going to be like one of our clients or some of our clients. What's the interest rate today, Mr. Weber?
Mortgage interest rate today is somewhere between 5 and 7.5%. How does that sound?
Thank you.
Right.
Now explain why. And we're just kidding, right? We understand that consumers out there don't really understand it like we do. It's a very valid question when you ask, hey, what are the rates today?
Every situation's different. And that's what people need to realize. There's more than 20 different items that go into our pricing engine that spit out an interest rate for a mortgage. I tell people all the time, I love using this analogy. Someone with a very clean driving record is going to have much less of an insurance cost than somebody that got 5 tickets last year. Just like somebody with a 780 credit score is very likely, almost certainly going to get a better interest rate than somebody on their mortgage than somebody with a 680 credit score.
Another really great analogy. So that's awesome that you brought that up. 3 things that you can control. 2 things. Your credit score.
Credit score, big.
Higher the credit score, better the interest rate. The other thing would be down payment or equity that you have in the home, right? More equity yields better interest rates in most cases. But again, there's caveats to that as well too.
Right, because wealth creation starts with the purchase of the home. Just because you put down a 5% down payment doesn't mean that you can't build that wealth through real estate. And I think that's what people are so intimidated by. I'd need to put down 20%. I could tell you 100 reasons why you don't have to.
Yep. I love it. I love it. And with our guest on later today, we're going to kind of get insight on where we think rates are going to go. We are not, we don't have crystal balls. If we did know, we'd probably be in Monaco drinking Mai Tais right now if we knew where rates were going. But we're going to try to give you as much insight on where we think interest rates are going at any given time. This is ever changing. We get about 80 pricing adjustments through all of the investors and lenders every single day as to how the market's moving. So this is an ongoing fluid situation, but we'll do our best to kind of keep you guys informed on how those rates are moving. Anything else on the rates?
I think that's a good place to close on this. The federal funds rate, which we talked about when this segment started, that is updated or changed, quarterly?
Yes.
Mortgage rates, again, they trade each and every single day, just like any other stock or bond. So to try and correlate a rate that moves a couple times a year in comparison to mortgage rates that move each and every day, it doesn't make sense. And that's why we're here to educate people on things like that, because I wouldn't know, right? Like I have no idea how computer science works. Right. I took a class in college, but faked it till I made it through that. This education piece is the main reason why we're doing this.
And if you ever want to get a personalized quote, you can DM us on our Instagram page, the Loan Lab Podcast Instagram page. We're always here to help and shed knowledge, but on this broad kind of platform that we have, that's why I asked the question, what are rates today? And you gave such a wide range. It truly matters the specific day, the specific criteria, the specific situation. And we're always here to give you guys any sort of personalized quote or whatever it might be.
Always. It's our job.
Awesome. All right, now let's bring this into our second segment. This segment is called Lab Tested Questions. We're going to try to do this on every single episode if we get responses from people, but if not, we're going to kind of bring this in on every other episode, depending on how many responses we get. We got some great responses from us putting out, hey, ask us anything about real estate so we can answer it on our podcast, on our Instagram pages. We're going to continue to do that. And if you guys can please continue to participate in this will be awesome. We got some really great questions, 3 of them that we're going to try to answer for you guys here today. So the first one from the man, the myth, the legend, John Sintich. John is the man.
Sintich, really good friend of mine, business partner of mine, one of the best, if not the best real estate agents I've worked with in my 11-year career.
And if you're watching this on YouTube, I'm going to drop his Instagram tag on the description so that you guys can go check out his Instagram. He does really great things, but we're going to read his first questions from John. So John asks us, how do you guys bring more value to your clients and your business partners in a high interest rate market? This is a really good segue from our first segment.
That's a great question and a great segue to your point. I think at the risk of sounding like a broken record, it does, of course, revolve around education. If there's anything that I can do to make sure that my clients are more informed than the next guy or gal's clients, that's exactly what I'm going to do.
Education and knowledge is key, especially like, John asked, in a high interest rate market. There are not a lot of, from a client standpoint, right? And I think he asked it two ways, one with business partners and one with clients. From a client standpoint, I think the education piece is so huge.
It's the key. And having the right tech on your side is obviously important, but what's more important, I should say, than that is using it and knowing how to use it. For example, I know we both create dashboards for our clients. We create analyses for our clients to show them interest rates and different options rather than just an Excel sheet or a quote over the phone or an email with a lousy interest rate quote like we talked about before. There's so many different ways that you can bring value to your client in that education piece by giving them kind of that platform and why you are different than the next guy or gal.
100%. And one thing I would add is, because we're talking about high interest rate market, is really taking the time with clients to talk about, this is what your monthly payment would be.
Yep.
This is how much out of pocket would be. But if we're talking specifically to high interest rate, and I know this might sound crazy, but the rate means nothing. The payment means everything.
Focusing on payment has been huge for not only my day-to-day, but my career the last couple of years. Being able to, we just talked about mortgage interest rates and the movement. We don't know where those are going to go. We don't have the crystal ball. But what we can articulate is a payment. That this is a fact with a 30-year fixed mortgage. It's an inflation buster, right? It's an inflation hedge. That mortgage payment will get easier over time because it doesn't move. The principal and interest portion, at least, does not move.
Yep.
And people make more money over time.
And then let's talk about business partners, how we're bringing value to business partners. I can think, it's tough right now.
It is.
It has been tough for 2.5 years. Since 2023? I mean, it's been
end of 2022, really.
End of 2022. It's been tough because what happened was interest rates pop up, skyrocket, and then home values
Not only did they go up, though, sorry to interject.
You're good.
So quickly. They went up so fast and at such a wide margin, it caused everything to halt.
So interest rates go up, skyrocket, as you said, which is a great term. And home prices were already up from the COVID.
Demand is still high. Some markets took it on the chin a bit.
So the reason I'm bringing this up is, to my first point, is it's been tough in this industry. You're seeing stats out there of agents leaving the industry, of loan officers leaving the industry. There are less transactions, a lot less transactions going on. So this point or question that John brings up about bringing value to your partners is, I think, super important. And I think one of the things that we do is we're so collaborative with each other. We're competitors per se, right? We still, we kind of work in the same areas sometimes, but being collaborative, not only with people in the mortgage industry, but people in the just real estate industry in general, is super key because we're all trying to brainstorm and give each other ideas of not only how to just get business, because that's not the main focus. Of course, getting business puts food on the family's table, but we want to help as many people as possible. And the way to do that is to be collaborative and be collaborative with agents out there. And we try to provide value from social media, how to post on social media, from asking people to come on this podcast.
Right.
I think collaborative would be my word. Is don't matter who you are out there, as long as you're a good person and want to do right by the client, we're all in on helping any of our referral partners out there, whether it be, again, doing events with them. I've been to an event with you and John. It was an awesome client event, right?
Absolutely. You've got to be able to do that stuff. And again, that's not in an effort to set yourself apart. I mean, you could look at it one way, but it's also just about caring and becoming friends with the people that you work with and work for, right? Oh man, there's a great quote out there that people don't care how much you know until they know how much you care. And in this market especially, being able to show people that you care about them and their transaction, and for the business partners, their clients, that goes such a long way. Gone are the days of this being so incredibly transactional, at least in my mind. And I know that you share that same sentiment.
For sure. Again, John, thank you for the question. I think
Great
that was
question.
an awesome one. Next question is from @Sydney Schleicher.
Wifey.
This is my wife. It's Sydney White, but she still has the @Sydney Schleicher. She wants to know, how do I convince my husband it's time to move when you currently have a 3% interest rate?
Is that not the golden question?
This is the golden question. And she was worried about asking me this. She's like, I think you're going to get pissed because, so here's the story. We were just talking about it too. we're kind of back and forth. We have a growing family, right? We want to get closer to a specific school, whatever it is. I got that dirt low interest rate though,
Sure.
right? This is not just our situation. This is so many people's situation out there.
We're going through the same thing right now. That low rate on your mortgage, I know, of course, it's a debt. It's really good debt. You could argue that it's an asset. That's how low that rate is, right? Because you could turn around and rent that home out and really cash flow extremely well. Now, the problem with that, of course, is many Americans need that equity in that home to be unlocked to buy the next home, right? So luckily, home values haven't dipped. So your equity position hasn't changed, but that mortgage payment on the next place, all things considered, is going to be higher, assuming you want to upgrade still.
And that's the thing, right? So each place is situational, or each situation is different.
Is different.
We have a growing family. We want to move closer to school. The reason I am considering, and we're going to do it at some point, you mentioned equity.
Mm-hmm.
My home value has skyrocketed, and a little bit of luck involved with that as well too.
Good timing.
Great timing since I bought this first home. I am going to dump all of that equity into an upgrade.
Mm-hmm.
Again, for growing family, to get closer, all those different type of things play a factor.
Events.
That's how I'm getting convinced to get off of that 3% interest rate and go into a 7%, because
we're both doing this right now,
We
right?
are.
We're both thinking about it. And how can you possibly, sell is the wrong word, how can you possibly consult your clients to do something that you yourself don't believe in? You need to be able to believe in it to convey the message that this is actually a damn good idea, and here's why.
And it's all relative too. When I say upgrade, I mean, we're not, trying to triple our home value, but what the convincing factor is my payment going to go up? Yes, for the houses that we're looking for. Is it going to go up to where it's not doable? Well, of course not. It's going to be something that's doable as we've continued to grow in our careers, as our family has grown. And it's not this huge payment shock. The reason being is, we're circling it all back, because of that equity that I have that I can just dump into the new place.
You let it grow and you use it. That's the beauty of real estate. That's how people buy that next property, is utilizing the equity and the investment that they've let grow to a point where you can buy that next home.
So I think that's a very convincing factor for move up buyers out there, is equity has just been so, there's stats out there. I saw it over the last 5 years, I think nationally, average 57% on average home values have grown over a 5-year span. That's huge.
It's huge. And we hate to do the plug, but if you're a move up buyer in this market, you would be so incredibly surprised when looking at an analysis at these numbers. Yes, interest rates are higher, but again, you're using that equity to make that next home a possibility.
100%. All right. So thanks, Sydney, for your riveting question.
That's a great question. That's what we need, that kind of stuff.
Like I said,
man.
she thought I was going to get mad, and I'm like, Sydney, that's like a really good question that a lot of people out there are kind of thinking.
That's the question right now.
We appreciate
Two very good
that.
questions thus far.
Okay, and then last question from Spray and Mace, our boy Tim Mason. Now,
What a legend.
I want to prerequisite
Tim Mason.
this is, I was trying to stay away from this topic for as long as humanly possible, but
First episode. Let's go.
let's just get it out there. Tim Mason, Spray and Mace on Instagram asks, are the Bears back, baby?
Bears.
Are the Bears back? The Bears
You're
are so
asking me?
back.
Absolutely.
The Bears are so back. That's a great question, Tim. Jimmy and I are diehard Bears fans. We talk about
Diehard.
the Bears all the time.
Nearly more than mortgages, you could argue. At least in football season.
Yes. The Bears probably will come up on the podcast every so often, maybe not during the offseason, but Tim asked, are the Bears back? The Bears are
The
back.
Bears are back. The Bears
Bears
just
are
made
back.
the best coaching hire they've ever made sans Mike Ditka.
We're high on the Bears right now.
Absolutely.
We're high on the Bears. All right, let's go into our last segment of the episode. We call this segment, You Can't Make This Up.
Oh boy.
In our day-to-day lives, in our day-to-day work lives, we've seen some crazy different scenarios, and we're never going to talk about anybody's financials or anything
Oh, absolutely
like that.
not. That's not
just-
the point.
That's completely off the table. But there's some crazy scenarios when you're talking to a lot of different people who are trying to obtain a mortgage. And we want to share some of those funny stories that we've come across. I actually had this one 2 weeks ago where I had a husband and a wife were applying to buy a home. They unfortunately didn't have enough income to buy the home. So we were trying to figure
Which
out.
happens. That's normal.
Happens all the time.
Yep.
Happens all the time. I think the wife was salon owner or something, self-employed. Didn't put all the, writes off a bunch of expenses, whatever it might be.
Sure.
So of course we want to try to find solutions, right? You can try to get some more income. Well, what's the way to get more income? You can't just magically have that appear in the air.
You can't create it, but you can find a cosigner.
You get a cosigner. I said, if you have any availability, I was talking to the husband. If you have any availability for a cosigner, let me know. We can get them added to the application. I get a call from the husband the next day and said, yeah, I got it. I can get a cosigner. This will be good. Of course, I ask, okay, awesome. Do they have income? What's their credit score?
Need a full application, just like
need to get a full application. Yep. And then I asked, what's the relationship to you? And the husband wanted the his ex-wife, to co-sign on him and his current wife application to buy a home for him and his current wife to move.
So this isn't a refinance of a mortgage. This is a new buy.
This is a new buy.
Yeah. Wow.
This is a new buy. So I'm like, wait, what did you just say? You want your ex to co-sign for you and your wife?
Did you check with your wife?
I asked if the wife was okay with it, and he goes, yeah, it's fine. It's all good. Definitely was not okay with the wife. And
that rug was pulled underneath him.
The rug was pulled underneath him. So there's some crazy things that happen. People aren't necessarily desperate. I wouldn't call that, but people want to try to find ways to get approved, and they'll go at lengths to do that. And this was one that I have never seen where the husband asked his ex-wife to co-sign for him and his wife, and nobody was on good terms with this.
Right. That stuff happens, man. It's funny that that's your situation, because mine's quite similar. A client that is separated but not legally divorced. So the ex-spouse was still needing to sign documentation to get this refinance completed. The ex-spouse would not sign, which again happens, right? Normally these divorces go through, they're finalized, and then a refinance or a sale of the home is court ordered in order to split the equitable assets. The ex-husband or the separated husband would not sign the documentation. And then my client asked me if I privately lend money, if I could step in and be the lender.
Hey, Jimmy, can you break off? How much were we talking? I mean, was it a lot?
It was a lot of money.
Okay.
It was a lot of money. And I was like, hey, I'm flattered that you are comfortable enough to ask me, but absolutely not.
Oh my gosh, that's good. Yeah. That's good. So yeah, we're gonna try to get as many "you can't make this up" segments. We see a lot. We hear a lot of funny stories.
I think a good audible to this segment moving forward, Jimmy. Other mortgage professionals, if you're listening to this, throw us your wildest stuff,
please.
And we don't have to shout you out or anything. If you don't want to be named, that's fine. But we want the craziest scenarios to come into this. And we want everybody to hear about it.
We'd love that. That's a great audible. Yeah. If anybody's listening to this who is a mortgage professional, if you have some crazy wild scenarios, please send them in.
We'll laugh.
And if we'll shout you out, of course, if you want us to. We don't need to as well, though. But we want to continue this because this is there's a lot of those type of stories that are out there on a daily basis.
That happens every single day. Stuff like that happens every single day because people are desperate to obtain their funding. And especially on a purchase, when you're contractually obligated to do so, people get desperate.
Crazy. You can't make that up. So next, we're going to have on our very, very special guest. This is going to be our first interview. I'm going to just introduce him as he comes on.
Sure.
And then we'll wrap this thing up after we have on our guest.
Let's do it.
Okay, we now welcome on a very special guest, the first guest to the Loan Lab podcast, a recurring guest to the Loan Lab podcast. Potential co-host, Mr. Joe Gabrione. Joe, welcome to the Loan Lab podcast, my friend. How are you doing
today?
Great
to be here, baby. Great to be here.
Thanks for joining us.
Thank
a little
you,
bit
Joe.
about Joe. Joe got in the industry in 2011. He's been around for about 14 years. Started out as a loan originator, doing what we are doing, working with clients on a daily basis, and has since built a massive division here at Leader One Financial with 80 to 95 full-time loan officers. Joe is on the sales side of the Gabrione division. He really supports all of the sales staff as well as operations too. Last year, the Gabrione division funded over 2,000 loans for just under $700 million in volume, which is
a lot of families helped.
Which is a lot of families helped. And that's a testament to what Joe's built here at Leader One and the people that he has under him.
Yeah, it's really it's all the people, right?
So how we know Joe, been a long time.
It's been a while.
Joe actually hired us.
Fun.
Joe actually hired us. And Joe, kind of give us us and the viewers a little story about your career in the mortgage industry and how us three have
then what
come to
became
become
your
together.
baby?
Exactly. We got into the business in 2011 as an originator. My brother Pete took a chance on me selling logistics at CH Robinson.
Okay.
That was fun. And then, he was like, I think I was at my goddaughter's christening, and he was like, "What are you doing?" I'm like, "I'm crushing it at CHL." He's like, "Really? What's crushing it mean?" I'm like, "51K, man. I'm killing it." Right. And he's like, "You got to get into the mortgage industry." I quit the next day. Swear to God.
Really?
Quit CH Robinson the next day, took the test in 2 weeks, and I was licensed by May 1st. It was crazy.
Wow.
It was like, I'm done. I want to go. It just was exciting.
So did you have sales experience
just at that CH Robinson?
You
It
did.
was all outside sales. Bang the phones,
Cold calling?
which was perfect transition into the mortgage industry.
Yeah,
at
it's a
the
nice
time.
little training regimen, if anything.
Especially my brother's company at the time, dropping mail, was a little consumer direct, right? Inbound traffic was coming in. So it was an easy transition to start taking leads on the mortgage side.
Sure.
So how did you give a little, and it can be a shortened timeline if you want, from being on your own, right, to having 80 to 95 people that you support on a daily basis. We see your day to day. We know how busy you are.
Yeah.
What was that transition from being a single serving LO to your vision to now what you have now?
Yeah, I mean, the first 4 years, it was just, grind the phones, prove myself, right? Work hard, try to close as many transactions as possible. Transitioning into early 2015, the market was shifting there was a lot of online companies popping their heads up, right? The bank rates, the Zillows, those really started taking off back then. So went to my brother, Pete and Dave, being the entrepreneur that I am, right? I just wanted to start something on my own. And eClick Lending was born. That's how we all met, the OGs, right?
eClick.
So January 2015, we launched an online call center. All consumer direct, hired a bunch of guys like you right out of college or, 1 year job sales experience. Next thing you know, we had 40 LOs. It was crazy. You remember those days?
Yes.
Locker room, man. It was great.
Yeah. It was awesome. Oh, I miss those days, but I don't miss them at times too.
Yeah.
The guys just lined up out my door with credit reports.
Oh, yeah.
Oh, yeah.
And we'll
Next
talk
question.
about that, about how we took applications compared to now.
Yeah, way different.
So-
And then ultimately, Midwest Equity Mortgage was purchased by Celebrity Home Loans. Completely different model. Really
2018,
August of 19.
19.
Yeah, August of 19. And it was just a completely different model, retail mindset.
And explain that real quick for people who don't know what that means,
Yeah.
what a retail mindset means.
Yeah, it's eat what you kill, right? You got to go develop relationships. It's relationship lending as opposed to inbound sales lending, order taking, we used to call it,
Yep,
right?
sure.
That's what it kind of was back in the day when rates were so low. It was basically taking orders because we had the best rates and no fees. And that's what everybody wanted online. But then we got into relationship business. It was more of a P&L based, right? Profit and loss based model, branch region division set up, which was really intriguing to me because it was like, you could own the upside, go build something and you can reap the rewards, right? And that's, and basically built a region. Took me about 2.5 years, 2019, 2020 into 21, and then was able to grow, did $1 billion in originations in 21 as a region. So then back then that was the qualifications to become a division. Yep.
Awesome.
Yeah.
Awesome. And now we're here now at Leader One, and we've been here for 2 years. Joe has built something super amazing. We wanted to bring Joe on because the premise of our episode is new school versus old rules.
And I'm
Now,
not old.
We give Joe a lot of
it's not-
shit and tell him he's the boomer of the group. Joe is one of not only our divisional manager, but we consider you one of our best friends. And I think
family.
we're family, man.
yeah,
We
for
get
sure.
together with kids and go on vacations together. And it's been an awesome ride with you. And you, even though you're not old, you're still
Here we
old.
go.
You've been through
I
a
think
pretty
that's like-
rapid shift in the
Yeah.
mortgage industry. And again, it hasn't been that long. You haven't been in the industry much longer than us. But I think the shift of when you first started to now
sure.
has been expedited and rapid. So we wanted to bring Joe on here because he's so knowledgeable with everything that goes on in the mortgage industry, from client-facing interactions to dealing with different LOs to running his own basically company you run with the division. And he's seen a huge, massive shift. So
Some of it, right? He's only, like you said, 3 or 4 years more than us. But that feels like 20 or 30 because of the opportunities that Joe was given by his brother
Yep,
and Dave.
totally.
And then taught us because, you were an entrepreneur at such a young age.
Right.
And then that morphed Jimmy and I to
Exactly.
be in the seats that we are in today.
Yeah, and I think part of it too is just blessed with the opportunities that I've been given, right? My brother gave me the opportunity to come into the industry. He gave me the opportunity to start a call center,
Yep.
right? And then both Celebrity and Leader One kind of give you the opportunity to be an entrepreneur, grow something, build something. So that was, I've been given some great opportunities and luckily been able to take advantage of them.
You definitely have, and
Yeah.
you've been, and we're not blowing smoke. I mean, this is fact. You've been super successful.
blushing.
Yeah, you've been super successful in every single role that you have. So you're a great person to be on to kind of talk
Appreciate
about how the industry has shifted from clients to LOs to you, et cetera, as well. Let's get right into it.
Yep.
One of the first things I wanted to talk to you about was the biggest difference in loan origination from when you started to now. And this can go
Client facing.
This can go a variety of different
everything.
ways, but if you had to pick one huge difference between now and when you first started, what would that be?
I mean, I think it's the technology, right? 2011, it's, fast forward to 2025, it's just so different, right? I mean, back in 2011, 2012, I got in the business, rates were probably about 5.25%, So we didn't take that dip yet, but it was a great time to get in because it was the beginning of kind of that first phase lower. Fed started buying bonds, right? And kind of started expanding, doing some QE. So I think that, ultimately we were blocking and tackling, man. We were stacking our own files. We were going to people's houses to have them sign loan docs, right? Like everything was done by FedEx, right? Get somebody on the phone. Yeah, I'm interested. I'd love to, send me an application. Like you're in the office till 9 o'clock, like waiting for that last FedEx pickup. Like you just had FedEx packages, right?
Great.
And you were, praying to God, like you'd send the return label and you'd just be waiting.
Yeah.
Following
Hopefully
up.
they send it back.
And then the clients would go ghost and you'd be like, oh shit, they're not sending my package back. Dude. Like, but that was like, you started developing strategy. Like you were actually sending packages to anyone you talk to. Just send a package because you had a good conversation. Like, yeah, I'm going to keep following up, but like they're going to receive an application in the mail. And then it's going to be easier when the next time you get a hold of them, like, hey, I sent you that app.
It's right in front of you now.
Sign all the docs. Send
And
it
when
back.
you say stacking files, we're talking about paper.
Printing
Paper.
things.
Stacks.
I know when we got in, remember
We were the tail end of that.
We had but we were still taking paper, the Crispy app.
Crispy
remember?
app,
The
baby.
Crispy app was about a page.
Shout out to Ty Fiegel.
Yes, Ty Fiegel. It was
Yes.
about a page this long.
It was
and
legal paper.
Legal paper, yes.
Yes, it was.
That was customized with all the different things that we needed to ask a client.
Yep.
That was in 20.
Oh, that was the Bible for us.
2015.
That
2015.
Yeah, 2015, early 2016 in the shift, right? We were in Calyx Point back then.
And Calyx Point is like no
Loan
offense to those who are still
software.
using Calyx Point out there, but that is an archaic
I'm sorry
loan
though,
operating
to those
system.
that are still
You
using
shouldn't
Calyx
be.
Point. Wow.
So we were
Yeah.
paper apping back then. When's the last time anybody's taken a paper app in this room?
When's the last time someone went and got a loan app signed in person?
It's been
long
a
time,
huge
yeah.
change. So
Long time.
yeah,
So that's the biggest shift in my opinion, right? Like is that technology piece, the online application, the more digital experience. It's just made it way more streamlined to get things done in the industry. Has sped up times in a big way, which has helped the industry, right? It's somewhat gotten expensive though, right? Like FedEx and going to people's houses wasn't that expensive. The technology isn't cheap,
Sure.
right? So, I think the idea is over time, technology is going to, potentially save bodies. Another conversation. I don't know if I believe that,
Sure.
but I think that it has certainly sped it up, created a better customer experience for sure, right?
Yep, definitely.
Like filling out a digital app is seconds, right? Compared to signing 50 docs on pieces of paper and going to the mail and doing all that.
it's that Amazon type mind
Exactly.
frame. People
Yeah.
want their things now. They want
Now.
answers now. They want
Yep.
their products now. And that's
100%.
it's been a good shift. And like you said, there could be some arguments for is that taking away jobs or whatever it may
Right.
be, which we'll talk about. But
We'll talk about that. The
it's
cost to produce a loan,
it's a-
although easier, is far superior to what it once was.
Yep.
And there's a lot that goes into that.
for sure. I'm going to throw a little curveball at you.
All right. I like
Because
it.
we're talking about the difference in loan origination. Let's talk about how different it is for somebody to get approved for a mortgage now than it was back in the day when it comes to guidelines and those type of things.
Especially you right after 08, 09.
Yeah.
Right. That was
Yeah,
things
but
were more
here's the thing
stringent.
about that. No, because here was what was crazy about that time is HARP was coming out. You could go to 150
Yeah.
CLTV with Freddie.
What's
Freddie had a
up?
HARP.
So
you
what
could
is
be
CLTV?
150%.
Explain that
you-
for
It's the combined loan to value ratio. So it's how much you owe on your home versus what the home is valued at.
okay.
So we were going, instead of being, if you owed 100 grand and your home was valued at 100 grand, you'd be at 100%.
sure.
So you could owe 150 grand and your home could be worth 100.
You're still getting a
That's,
mortgage.
You can barely get a loan over 95%. Think about 150 back then. But again, the idea was financial crisis, right? We need to, the government was looking for ways to, the housing market drives the economy, right?
Sure.
They needed people to be able to save money, right? Because of all that was going bad in the world at the time, right? The economy at the time. So so it was actually kind of cool because streamlined refinances were big. They were new. The FHA allowed a borrower who was in a current FHA mortgage that was making at least 6, I think, months of on-time payments. Like couldn't have a late. You could just streamline, lower your rate, lower your MIP,
no appraisal,
right? No appraisal, no
easy.
income. I mean, it was literally stated income and a mortgage-only credit report. That's it, right? So it was, even though, the rates were higher, the economy was in a weird spot. And I think I got in at a good time. I think 08, 09, 2010, like I wasn't in the industry. And when I hear from people that were, like, those were the 3 probably hardest years. I get in at 11 and now new programs were coming available,
You were
right?
seeing like the blossoming back.
Exactly.
Yeah.
I kind of timed it. I didn't know it. Didn't know there was a T in the mortgage at that time, right? But that, I think that really helped, even though it was coming out of a really bad economic recession. There were a ton of new programs. Rates started already kind of creeping lower. And, 2015, 16, 17 were some of my greatest years as an originator. Yeah.
So technology has probably made it easier for people to obtain a mortgage from a experience standpoint. Whereas beforehand, when you were mailing out documents, it's probably pretty hard for people to get a mortgage. A lot of paperwork going around. The 08, 09 before that, it was pretty easy to get a mortgage because you can probably just walk into a place and say, hey, this is what I make.
Yeah,
sign
and
here.
They would give you a mortgage. And that crash, everybody go watch The Big Short out there.
Yeah,
that's a huge, great movie to kind of learn about what was going on in that time. That crash made it a bit harder for specific individuals to qualify for mortgages. You can't really get a mortgage now. You can, but it's hard to get a mortgage nowadays where you just say stated income or no income. There's
Exactly.
You have to be strong in other ways.
Strong in other ways.
Loan to value, right? But down payment, really, right?
Down
like
payment.
How much liquid reserves do you have, right? So there are tons of those programs available. But back then it was, not only was it stated income, they were doing these teaser, ask Joey P about this, right? They were doing 228s where you had a low rate for 2 years and then it jumped like 7%. So borrowers were getting into these homes and then the economy crashed, right? So now their homes were worth less than what they owe.
With a much higher mortgage rate.
And now their rate just jumped 7%. So it was like, why do I, that's where everyone just started walking away.
Crazy.
So can you explain why these new stated programs are so different than those ones before? In a nutshell, we could talk about this for a half an hour. But why are they more safe? Because
I think it's ultimately like we said, it's they're not doing them above, most of the time you got to at least have 20% equity in the property, 20% down payment. And they're looking at whether it's a business owner, right? They're looking at cash flow, which makes sense. We all know when you own your own business, you can have tons of cash flow, tons of revenue, but then ultimately not be super profitable, right?
It's on the bottom line. The tax system, right?
Exactly. So these business owners, self-employed business owners, they have tons of cash flow to pay their mortgage, right? These are some of the safest actually bets that you can make, right? Because we're analyzing their bank statements and saying, holy cow, they got $50,000 of receivables every month, right? Like they have tons of free cash flow.
Money,
yeah,
right.
Exactly.
Like the holidays do great for your business.
Totally.
Show the underwriter why.
I mean, there's definitely some crazier programs out there that are starting to kind of peek their head up. And I think it's because people are hungry for more options, right? In the industry, it's gotten harder to get a conventional loan, right? Guidelines, harder to get an FHA loan with a low FICO, right? So people, I think, are ultimately looking for other opportunities to kind of gain market share in terms of investors, right? Different investors. It's kind of crazy. I mean, there's a new investor now. I won't name their name, but they're doing stated income on primary residence, which is, or no income. It's a no income.
You don't even say what you make. They're just like, we don't care about your income.
Right? Which is like, but you got to put 30% down. So they care about the equity.
They give on some parts of the criteria of qualifying, but they'll take a lot on the other.
Yep. And there was always the NONI. That's been around a while. NONI is non-owner, no income. Okay. But now it's no income primary, right? Like that's almost absurd.
It's crazy.
Right.
But yeah, that's the evolution of this business.
I like it. Let's kind of transition into just the role of a loan officer today. Okay. What skills are super important today that maybe wouldn't have been as important as in when you were getting into the industry? You mentioned you were banging phones, right? Blocking and tackling.
Yep.
I think there's a bit of a contrast between that
Totally.
sort of mindset as a salesperson back in the day than now. Can you kind of talk about that and like what is transition for the loan originator?
For sure. I'll start by saying I think there's something that hasn't changed, right? And this is what you guys know, one of my old coaches, right? Like the person with the most friends wins, right?
Absolutely.
Like you got to cast a wide net in this industry. You know, you got to just try to put yourself out there and, you know, into a bunch of different referral partners. But like you said, I think what has changed is, at least, you know, from the consumer direct world, like what consumer direct is there right now? Right?
And
Like,
explain,
it's light.
what is consumer direct? Let's give a quick example.
Inbound leads. Company just, you know, employs loan officers to sit at a desk and answer a phone 8 hours a day, and they are providing the leads, right? They're buying leads on third-party websites, Bankrate, Zillow, right? Those are common ones that people have heard of, but there's hundreds of lead providers out there, right? The problem is that when rates were, that was great when rates were 3-4%, right?
Everybody and their mom could refinance.
Yeah, everybody wanted a loan. Now rates are 6. Now they're in the 7s, and you know, almost got to 8%. Like there's no refi business, right? In this market. I mean, you got some cash out, you got some divorce, you got some stuff like that, but we are a 92% purchase shop, you know, basically over the last 2 years.
Yep.
So you're talking about, you go from 40, 50, 60% refi when things COVID, right? 3%, 30-year fixed mortgages. And then you shift to 90% purchase. Like that's why you saw the amount of loan officers go from what, 350,000 only 3 years ago to under 100K this year in renewals. It's bizarre.
So can you explain why the relationship with your clients and partners is so much more important in a purchase market than a refinance market?
Yeah. I mean, at the end of the day, right, the referral partner, whether it's a realtor, a financial advisor, a divorce attorney, right, like you need to be able to educate. I think that's so important in this business now, right? Like if you don't know what you're talking about, like you're just like all the other ones that are no longer in the business, right? Like I think education for our clients, but not only that, like what value are you going to provide that referral partner? If you're not
How are you different than the
going to
next
somebody
guy?
with your hand out doesn't work anymore. There's not as much, you know, you used to be able to not, you know, show up at realtor shops and be like, I'll do a lunch and learn and I'll bring some donuts and coffee. Can I get a loan? Right? Like,
Let's get a loan going.
Now it's like, dude, it's you need to educate, you need to provide value, you need to teach these realtors how to
Gain
go
that
out there.
trust
Yes.
in the ways that you just
Yes,
said. Whereas
100%.
before it was, hey, I'll take you out to
Right.
Vegas, you know?
Yeah, let's
That's
go
the
have a couple
extreme.
beers and send me a loan, right? Send me your
Right.
next buyer,
For sure.
right? Like that just doesn't work anymore. Doesn't work.
And we went through this shift, Jimmy and I, and you did too, you know, being kind of our mentor and leaders. And you were actually one of the first people to tell us, hey, get out of that consumer direct, start, you know, building relationships
Planting
with people
seeds.
and becoming friends with people. And I'll tell you one thing, and Jimmy can probably say the same thing, is that's such a building relationships and
Huge.
becoming friends
Everything.
with people. It's not only huge, but it's such a better way to go about your daily work life.
Right.
Yep.
Instead of just grinding phones and being so transactional with
Right.
everybody and just
Tied to
where's the next
email,
deal.
yeah.
Well, and I think what happens is when you become a retail LO, it's no longer a job, right? Like it's almost fun, right? Like you're not, like you said, I'm not at a 9 to 5 at the desk answering phones. Like the best part and the worst part is that you make your own schedule, right? So if you're not accountable to that and you're not right, like it could be the worst part. And that's why a lot of loan officers have failed in this
Right.
market in the retail side. Is like you can be lazy. You can work from home in your boxers, right? That's the new COVID world, right?
Sure.
Like, or the ones that are killing it are out there. They're still educating. They're still getting in front of their people, and they're providing value. They're providing value to their whoever that referral partner is. Doesn't have to be a real estate agent.
That flexibility can be a gift
Yeah.
or an absolute killer.
Totally. And we've
Absolute
seen
killer.
that big time in this business.
Some of the best in the business just got out because they got
I mean, I've seen
They
it
got
in
tired
our
of being
division,
tired.
right? Like honestly, we have 30, 40, $50 million producers, right? Between 2020 and 2023. And now they're out of the business. They're
Right.
gone. It's crazy.
Yep.
Right. And they just didn't shift. They kind of got left behind.
So
right?
testament to you with us, at least. I mean,
Dude.
you told us, and that was a big leap for
It was
us.
a scary time, man.
scary
It was a
for
scary
everybody.
time. You
Remember
told
that?
us, you said,
Yeah.
get out of this part of the industry and start going and building
Exactly.
relationships with people. And it's probably the best thing you could have told us. So
Yeah.
you were the whisperer then, for sure.
It wasn't easy. Remember 2019, right? Like
Yeah.
It was
every
scary.
purchase was like a celebration, right?
Right.
Like it was like, because we started with nothing. But what I will say, and I think you guys will agree to this, don't you think building a pipeline, your own pipelines from 2015 to 2019, inbound, taking how many you guys funded by starting? And I think this is still, unfortunately, consumer direct isn't a real viable space to get into because like I said, there's not a lot of transactions happening on that side. But I think it's important that you guys were able to get in and build a database without just starting with nothing. I think your trajectory would have been way longer. right? The transition into retail would have taken way longer. You at least had your book of business.
And we
right?
had transactional experience. We
Yes,
learned
So many at bats, so many repetitions.
Yes.
we can process loans now if we
Yes.
needed to. We know
Exactly.
the underwriting guidelines because we were forced to,
Yep.
because we were doing all of that business, which was,
Well, you
it
didn't
was
have Chat GPT being like, "Hey, Fannie Mae, what is this guide?" Right? Like
just
you
had
had
to
to like
know
go
it.
find it.
Yeah.
Like, you know?
for sure. And that's probably, I'm glad you brought that up, Joe, because I get asked from realtors, or I've seen from realtors, like if they're just getting started, like
Yep.
what shop do you want to go to? Where do you start? Like, how do I start my business? It is so extremely hard to start your business by going and killing what you eat.
Yeah.
Self-generated. So I've seen realtors ask that question, and my answer to them is go find a team that can help provide you some leads while also teaching you how to get your own leads as well too, and being self-generated.
You need a mentor.
You need a mentor. You
mentor.
need a team.
Yep.
Is what you need in this industry, and
Or
in
you need
any
a
sort of
coach,
industry.
right?
Or a
Like,
coach.
Or a coach.
Correct.
Some great programs out there. So it's like, but you need somebody to motivate you, kind of show you the ropes. They've been through it, right? Like walk in my shadow and I'll show you how to get there.
Sure.
And then ultimately, like I need it, right? Like everybody needs an accountability partner almost, right? Like put me in check a little bit.
Sure.
Right?
Sure.
Like that's important.
For sure.
I mean, we're all busy as hell trying to manage, it's just, you gotta find ways to manage your time. And I think having a coach or an accountability partner just kind of almost guarantees that's going to happen for you.
100%.
And we had that in you, though, dating back to those days. I
Yeah.
often
Oh, yeah.
tell myself, oh, I wish I got into retail sooner.
Right.
But in reality, I wouldn't change a thing.
No.
It all worked out because I learned so much under you.
Probably did
and-
thousands
and
of loans in
from
4
him
years,
and every-
right?
Yeah,
I mean,
exactly.
thousands. Think
like
about that.
Again, it sounds like a broken record, but so many at bats.
Yeah,
Learned
exactly.
so much.
Yep.
Well, I love
100%.
it. Well, we've talked about, the past. We've
Yep.
talked about kind of where we're currently in. Let's kind of shift
I
to
like this Gabrielle.
There you go.
There
That's
we go.
that's that free promo,
Let's go.
baby. That's that
Wow,
free
just
promo.
noticed that. Look at
Gabrielle
that.
Group,
Good
if you're
salad.
looking to
Man, I got
join
another
up.
shirt today. This
Yes.
is
I love it. I love it.
Let's
Promo
go.
Thursday.
So we talked about past, old school. We
Yep.
talked about what we're currently doing right now with the retail. I want to kind of take a shift into the future, and we're going to touch on two things. The first thing is you are the rate whisperer.
Wow. Wow,
Okay,
I like that.
you are the rate whisperer.
Bond boy.
Wow.
We want to know where you think the current rate market cycle. What's your opinion and
Yeah.
prediction on where rates are going? Everybody, we were very rate centric in this episode because that's the hot topic all the
Okay.
time.
Okay. I
So
like it.
it's more than it's only right that the rate whisperer gives
Wow,
us
the rate
his,
whisperer. How about that?
his
I
opinion.
like that name though. I think we're in a weird market, right? President, new president. I think that creates some question marks, right? Because there's a lot of arguments on one side that, his policies are actually inflationary, right? So, okay, that's not good for rates. We know that. We just came out of the highest period of inflation we've ever seen, at least since we've been in the industry. I read a lot of articles. I subscribe to all these rate, people that claim to know they know what they're talking about. But the reality is I don't have a crystal ball, but I would think that with super high debt ceiling, right, for the government, super high oil prices, stock market at all-time high, where you can get way better return there than you can by buying bonds, right? Like we need people to buy bonds for rates to go down for anybody that, right? Like that's the inverse relationship of the market that we're in. Bond prices go up, interest rates come down. So I can't make an argument for rates to come way down. Right. I actually think we could see them touch 8% before we see below 6 again.
That's a hot take.
Yeah,
I'm
it is.
telling you,
That is a hot take.
Like there's just a lot of problems inside of the economy still, right? And I ultimately think that until we have a clear plan on the government lowering their deficit, right? There's a fear over like they're not going to invest in government bonds, right? Like so I think that's an important issue that we're hoping that this president can figure out, right?
At what point does the president continue to ask or demand for lower interest rates? That he actually, I know he can't force a Fed cut,
Right.
but can he force them to start buying MBS again?
Nah,
Mortgage-backed
I don't
securities?
think with the current Fed chair. I don't think that you can kind of tell they almost have he's standing his ground.
Yeah.
It's like Trump ain't telling me what to do,
Yeah.
right?
But his plan-
I think it would be really bad if the country ever went to where the president could have influence there on monetary policy. That could be a bad thing, right? You
We
get the
saw that
wrong
a lot in
president in the
COVID.
office, and now they're controlling rates.
Yeah,
right?
I mean, Trump would tweet and the market would go wild.
Right, exactly. Now, COVID, a little bit, I'm glad you brought that up. Like that was a pretty black swan event, let's call it. Right?
Unprecedented.
Basically.
It's not, like what happened? And I think the government, luckily, like they were smart enough to step in and say, we have to be the biggest purchaser of bonds, right? So they just drove the bond market higher, right? Because they were buying the bonds, which just drove interest rates to unprecedented levels. And to be honest, if COVID didn't happen, we would have never seen a 3% 30-year mortgage. No
But
chance.
to your point, they used real estate to take them out of that really low point.
Yep. Exactly.
So you just said we would have never seen
maybe 2.5 is what we probably the low. The 2.5 was probably the low on the 30-year fixed, right?
Are we ever going to see that again?
I
know you.
I think
I know you don't know.
would have to happen.
Right?
Catastrophe.
Yeah.
I think we'd have to have some kind of another black swan. You know, let's pray to gosh it's not COVID, right? Like, I mean,
Of course.
you know, we don't want another one of those for a couple of years where we're all locked up. But I mean, war, you know, I think it's a lot of the uncertainty stuff that would cause rates to potentially go way lower.
And I think that's a huge point. We make a lot of content about that for people waiting for rates to go down. It is black swan is a black swan event is what you said. That is extremely, it's impossible to time. No. Those are anomalies.
Exactly.
It is impossible to time.
I agree.
So what do you think a stable market is for the next
I mean, I think
4 or 5 years.
What's great is that we've had, you know, I look at it from a different lens sometimes. Like we were running out of people to transact with, right? Because everybody had a rate in the 3s, right? Like there's not much else you could do, right? The beauty of it is we've now been able to serve people with higher interest rates. Is, you know, that sounds bad to say, but what I mean is it's going to give, at least from the mortgage side, right? Just talking straight from the mortgage side, it's going to give our people so much opportunity and borrowers, right, to refinance that mortgage and get into lower rates and with a lower payment. I don't know what else, like like I said, I mean, outside of and I think what's beautiful about the current economy is home prices have gone up. Right. So there's now opportunity. People have used credit cards to leverage their debt. Right. And now they're realizing, well, I could leverage my equity in my home. Right. So that's even starting to provide value right now. Right. Even in this rate environment with a 7% cash out refi rate. Right. So imagine, I think a healthy is in the 5s, right? That like kind of where full circle where I got into the industry, right? 2011, 5 and a quarter, 5.5. That was healthy. People were transacting still. Right. And it just brings, I think the major problem at the current interest rate level is affordability. Right.
Absolutely. One thing you said that I love, that number, the percentage of interest rates on a mortgage below 4% last year, a couple years ago, whatever. It was at 90%.
Exactly.
That is ticked below 75% now. So it has taken some time for that to go down. But more people are at these higher rated mortgages because, of course, they bought new homes and they need to be helped when rates go down.
Exactly. So I think we're kind of building up almost for the next cycle, right? The next cycle of, let's call it refi. And I use the term refi boom lightly, like it'll be a refi pickup, right? Like I don't think we're going to like 60% refi pipelines, but if we could go from 8% where we are today to 20, 30, like that means everybody just got 20% more business, right? Which is good, right?
And we're saving people and that affordability problem that you just mentioned. Hey, we're getting your payment down. Awesome.
100%.
I love the idea of a refi boom for our wallets.
Yeah,
I don't love it for the long term because we'll just be in the same situation.
Same
cycle.
Well, awesome. We're going to stay on this future and kind of wrap a bow on this. Talked about interest rates from the Rate Whisperer, which was awesome. Thank you. We want to just know about the future of the
co-host.
We want to know about the future of the industry. We talked about AI. We've talked about the past, the current rates. Where do you think the industry is going? Do you think robots are going to take our jobs?
I do not think robots are going to take our jobs. I do think though it's already happening, right? There is a shift to the AI, right? The automated underwriting, some of these voice bots are freaky good, right? Like it sounds like a person, right? But it's not. Somebody calls into the 888 number and it's a flipping bot talking back, and it's smart enough to know what the client is asking.
Having full-on conversations.
Full-on conversations, and the person has no idea it's a bot, right? That's happening already. That's super advanced. That's some of the more cutting edge. Probably there's a handful of tech mortgage companies out there that they're just investing millions of dollars in tech, right? They're trying to be some of the kind of front runners and pioneers of the shift. I think the shift is real. We have to embrace it. But I think that I just always say I don't ever envision a realtor referring somebody to a robot. I can't imagine that, right? Especially with the education that we talked about, right? Like that's never going away. And I know you guys have talked about it a ton. One thing that lacks in school, right? And when we're growing up is learning about the biggest asset we're ever going to purchase.
And the biggest debt you're going to take on.
So I don't think robots are going to replace loan officers. I think you're already seeing this shift in between high interest rates, lower inventories, and tech. You're seeing way less loan officers being able to survive, but the good are are always going to survive in this industry, in my opinion.
I
don't
think it goes
that's going
back
away.
to the full circle again when you had said that with eClick, right?
Yep.
We were order takers.
Yep.
But humble brag for he and I, we're still here.
Exactly.
There was still a
Exactly.
differentiator.
Yep.
And that was the human element.
100%. And you guys took the bull by the horns and said, just based on everything you learned and who you guys are and how you're wired, right? Like failure wasn't an option.
No, work
right?
harder.
Wasn't an option. So
Yeah, and I think, again, to put a bow on it, the future is technology. It's AI, and the technology has helped the consumer experience big time. With speed, with efficiency.
Yep.
And I think that's going to continue to happen for the consumer. And it's also helped us too. I mean, look at us right now. We're doing a damn podcast that we're going to put out to people that we can have everybody listen to.
Super exciting.
We didn't even think about that, back when we got into the industry. So I think the technology, we embrace it here.
Yep, totally.
I'm totally on it with you though, that I still think that trust factor with an actual human, whether it be from a referral partner or buyer, seller, whatever it might be, I think the humans have stayed. They're going to stay. We're going to be on top.
Yeah. 100 years from now, I don't know.
Yeah,
I can't give you any answer. I think, in our lifetime, the loan officer is still super important. Vital to that. Again, I keep going back to that educational piece, right? Like most first-time home buyers have no idea what they're about to kind of get themselves into, and they don't know, how to calculate a mortgage payment. They don't know how much money they need to put on a house, right? Like they just don't know a whole lot. So that piece of education, I don't think you're going to trust a robot or it would already be happening. Like you can go find a lot of this online, right?
For sure.
Like it's that trust factor. Like I'm talking to somebody that owns a home. They're in the industry. This is what they do for a living. They've closed thousands of transactions. Okay, this feels better. Like walk me through this process. And we kind of become partners with our buyers, right? Like along the way. And I don't think that's going anywhere.
No, it comes down to like anything else. You just need a guy,
Yeah,
right?
yeah,
You need a guy.
exactly.
You got your mechanic, your car. What you need your mortgage guy or gal. You
That
need-
advisor, right? Like
Exactly.
That's what we are.
And they need to play a big part in your whole wealth team.
Exactly. Because I flip it. We're debt advisors, right? And then we got the financial advisors. Do you ever see the financial advisor going away? Just believing in some robot telling you to invest in Apple, right? Like,
It's
I
a
don't
great
see that
point.
happening, right?
It's
So
a great point.
I don't see debt advising going anywhere anytime soon.
Love it.
Yep.
I love it. You guys have anything else? Any other questions for Joe, Jimmy?
What's next for Leader One?
Oh man, I'm excited. I think 2025 is going to provide a ton more opportunities. I think, like I said, I think there's tons of equity in the market. And I think that hopefully we're going to start seeing some of the, I think in Q3, Q4, we could see, a slight tick down in rates. And I'd love to see the housing markets, there's some more supply come on the market because I think that's hurting us. I think every realtor you ask is like, God, we could use some more houses to sell.
Sure.
No, but Leader One is we are really focused on really doubling our production over the next 3 years. I think we kind of came in just under 1.7 billion in 2024. We have a goal of about 2.5 billion in 2025. So we're looking for some serious growth. It's exciting.
That's good for everybody.
Yeah.
More origination.
Exactly.
We'll take it.
Exactly. The only thing I did want to talk about was the, you had asked me earlier about the, kind of leadership role from loan officer to division president, right? And I think that like one of the things that kind of drives me is that I still am in the weeds, right? I'm still getting clients that reach out. I've done a lot of loans over the years, so people still reach out. So I still originate, just not in my name, right? There's so much that I've learned that I've hated about the business, or that things that I think should be fixed or done differently. And I've really taken that over the years, right? And been able to use that in a leadership role to fix them for our people, right?
Sure.
To make the system and the process better, and just empowering guys like you, right? Like it can be cheesy, okay? Power to act, right? I've been using it a while. Right. But that autonomy, control, and transparency, right? Now you guys can spread your wings and grow. You know your market, you know your database better than I do. I just want to give you the tools. And you guys are going to crush it. And I think that's what Leader One's all about. And that's super exciting.
It's
allowing
exciting.
us to grow.
Give us the tools to implement and
Exactly.
take it and run with it.
Exactly.
That's what Leader One's all about, and that's what you are all
Hell yeah.
about. my friend.
Absolutely.
Hell yeah, baby.
You really are. So
Hell yeah.
it's been
Home Lab podcast, baby. This is hot.
Home Lab.
This is
it's
hot.
been amazing to go through this journey with
Likewise, man.
both of you guys.
You guys are like family.
And
Love it.
we are
Without doubt.
family.
Yep.
Like we said, we get to kids together, birthday
Yeah.
parties,
All the
like all
time.
that type of stuff. So it's cool. There's been some tough times, but
Yeah.
hey, we're that's what happens.
Made us stronger,
sometimes.
made us closer.
Definitely
right?
has.
That's the best part.
So this is we're gonna cap it off here.
All
the
right.
first episode of the Loan Lab
Wow.
podcast. Thank you to our first guest, recurring
co-host.
guest,
Mr.
and
Gabrielle.
co-host.
And co-host.
We appreciate anybody out there that is watching this, that is listening
yeah.
to this. We are super grateful to be sitting in these 3 seats,
Yep.
to be serving people out there to buy homes, get mortgages, refinance their mortgages. This has provided so much I don't know.
This is an outlet.
Gratitude, right?
Yeah.
That's the only word I can use to describe it.
It is gratitude.
So grateful.
So
Yeah.
we're glad if you are watching this or even listening to it, we appreciate you and thank you. And this is going to
thank you,
be
guys.
a hell of a ride, and we're glad that you guys are on it, and we'll be back.
We'll be back. I'll be back for sure. Let's go.
Peace.
Let's go. God, that was good.
That was
Is that?